Well, the potential impeachment of Trump, it is a huge overhang, or should I say hangover, for the markets. As some analysts have said, it reduces the odds of his pro-growth policies, such as tax reform, deregulation, infrastructure, spending, etc., of those policies getting passed. Whether it's true or not, the market is largely based on perception. So if this perception becomes more bearish, that could put more pressure on stocks that have partially priced in a tax reform bill, among other economically favorable policies that Trump is seeking to get through. Of the major indices, on Wednesday, the financial ETF XLF, that was down the most. And then on Thursday, yesterday, it bounced weakly, while the 20-year U.S. Treasury bond ETF, that's the TLT, that sparked higher. Now, both are signs the market is seeing lower odds of an economic recovery via Trump's policies. And along with that come two major headwinds that we've talked about. First is the slowing GDP, and also a Fed that has painted itself into a corner and has little choice but to keep hiking rates. And that's their effort, their attempt to put more fuel in the interest rate gas tank, because despite the two 25 basis point hikes, interest rates are still near all-time historical lows. Also, despite these headwinds, we've got a counterforce, a manipulative counterforce, which is QE. And that's certainly been a force with which to be reckoned as global central banks continue their material QE campaigns, and they've been this QE has been responsible for putting a shallow floor under the U.S. major markets. Singularly, QE rests these markets from having meaningful corrections, and since February 2016, and that's what, 15 months, the S&P has only had two mild corrections, 5.9% and 5%, and those both came in 2016, and that's despite all the political fireworks. So, the issue is when are we going to get out of this QE mess? When is some sort of meaningful correction going to happen by way of the Fed hiking rates, or perception going very sour? That can happen from a number of channels. The EU is obviously an issue, and its days are numbered in terms of its stability. There's a lot of things politically that could come out of left field, and you just need to be very vigilant in terms of watching your price volume action in the majors and in stocks. Speaking of which, BABA gapped down on its earnings report yesterday, but it managed to have an undercut and rally. It undercut two major price points, then finished with a pocket pivot, closing near the top of its range, as you can see, and then it gapped higher today. But you have to be real quick about these sorts of price moves, especially in these kinds of markets when news hits and volatility spikes. Speaking of which, also JD found support at its 10-day moving average, and that also represented a lower risk entry opportunity for those alert to it. You can see that a number of these leading stocks, including the Chinese stocks, move quickly, so the window of opportunity can be quite tight. The tech juggernauts, Amazon, Facebook, Netflix, they all bounced off key support levels, though they did so on lower volume than the preceding down day. Now, Amazon is the front runner, as it's already about to hit new highs, but the others, as well as the general market, have had some damage, and they may need a little more time to back and fill before resuming their uptrends. And it's not surprising to me that Amazon is actually, on the verge of hitting new highs today, because to me, it's really made all the right moves. Very forward-thinking in terms of utilizing the size and network effect of their company to implement strategic technologies and ideas into the marketplace very quickly. So you get a company like Amazon, Facebook, or Netflix, if they open up a new area, if they see an opportunity in a new space, and they go into it, their network effect takes it over. So in other words, they instantly become number one in that area, provided they execute well. And so far, all three companies are executing exceptionally well, which explains why they are at the market caps they are and why they're in fairly formidable uptrends. In terms of also, Baba is another one of these. That's the Chinese Amazon. Keep in mind that because of their size, and this goes for Apple too, they're not going to be, the younger spring chicken stocks that are, smaller cap oriented. And I don't mean small cap. I mean market cap, say, under 5 billion or under 10 billion. They're not going to necessarily move at those speeds, but they also tend to be a little bit more consistent. And I remember O'Neill used to talk about, telling me, he used to say I like the wild thin things. And back then, that was the low-hanging fruit. And based on the size of money I was running, it was the best way to go at that time. But I could see his point in terms of, if you're running 9 figures, it's better to be sometimes in an Amazon or Facebook because there's less volatility and more predictability just by virtue of the lessened volatility. So your risk is less with those types of names. And for members who have a lower risk profile, who don't want to be involved in wild stocks that are leading, and they might have all the characteristics to be on our focus list, but they might be a little bit too volatile. So the Amazons and the Facebooks might be a better choice for those types of members. And at that, let's hear what Gil has to say about stocks in the market.
I love this market. It's just a great swing traders market. And for those of you who follow me on Twitter, you know that I got short the market on Tuesday. Okay. I'm going to puff out my chest now and brag. But realistically, you could see things getting pretty extended at the time. A lot of people were spewing bullish comments at me all day. But you could kind of see that I have this extension indicator that I use, which is an aggregation of extension from the 10-day and 20-day and 50-day moving averages in a list of leading stocks that I watch. And that was just giving me a really high reading. So I decided to take a couple of short positions, like in Tesla at around 319, and there's a couple others I'm trying to remember. And also I went long the UVXY somewhere around 12, and then that had a nice 35% move on Wednesday, and I sold into that move before the close and covered my shorts before the close. And then yesterday in the morning, and actually also Tuesday evening, I was noting that the selling looks really ugly. If you look at the NASDAQ chart here, that just looks really, really ugly. Okay, would anybody say that it looks anything but ugly? I mean, you get this massive break and the volume's heavy, and everything on the planet is getting smashed. All the stocks, all the leading stocks are getting smashed. If you look at, look at Facebook, for example, and I would say it's still really not out of the woods, but I mean, that's a hard break. But it comes right down to the 50-day moving average, and if you step in on it, you could actually take some shares here and catch a trade to the upside. I know yesterday I was tweeting about, Baba was actually an undercut and rally, if you saw that in the morning, and I was pointing out that you really don't want to get locked into a bullish or bearish bias at any point in time. It's very difficult, especially when things start to look too obvious one way or the other, and that's just the way this market is. Now, that said, how does one make big money? Do you sit with stocks and try to sit through stuff? And I think that's a valid question. I like to take a swing trading approach where I'm selling into extreme strength when everybody else is giddy, such as they were on Tuesday, and then looking, at least having a pocket full of cash so that I can think about what I might want to do tomorrow. Either way. And actually, yesterday I did scalp some profits on some shorts, but mostly it was the longs that were rocking. And if you look at, say, Facebook, right off the 50-day, but also Baba, and I was tweeting about this in real time yesterday, Baba undercut all these lows. So what does that set up? It sets up an undercut and rally. So it gaps down, and it's just looking really grim. And if you're watching it on the 620, I'm always watching, these stocks that are gapping down, if they're big leading stocks, okay? And I think an undercut and rally buy setup is your most powerful weapon whenever the market's coming off like this and you get an oversold bounce like you did yesterday. And everybody's screaming that, it's the end of the world, and it could be, you know, but at least you can keep your stops relatively tight, because the undercut and rally trade is a very simple one to execute. I think this is a 114.80 low here, and this is a 114.62 low here. So as soon as the stock gets above either one of those lows or both of them, then it can be bought on the basis of the undercut and rally setup. It doesn't mean it's going to work, but at least you can keep your risk to a bare minimum of, say, 1 to 3% below these two lows, okay, and run it that way, you know. So as I like to say, it's like you got to be an algo cowboy. Thanks for reminding me about that one, Scotty. But sometimes that's what you feel like. You're just an algo cowboy riding all these freaking algos as they're, you know, galloping about back and forth, you know, and you get that feeling. But if you look at a break like that, here's a nice steady move to the upside. So if you've been playing this, you know, boom, boom, it's just kind of trundling slower, da-da-da-da-da-da, you know, whistling while it works here and goes higher. And all of a sudden, boom, they hit you like that. Now, if you're long the stock, your first instinct is probably to poop in your pants, okay? And if you're long the thing. And then yesterday morning, it's breaking the lower lows, and you're probably going through more pairs of underwear. But if you sold into the prior up move, or you were out ahead of earnings and not playing earnings roulette, and I understand sometimes that can work in your favor. Sometimes you can also blow up in your face. And that seems to vary from stock to stock. So it's not something I like to do. Some of you who are earnings roulette players maybe can, and maybe you get away with it, but I've never found in my experience that it works in my favor. You know, if you take two stocks going into earnings and I've got profits on both, the one that I hold will gap down, the one I sell will gap up. It sometimes feels like that. But in any case, you know, you can be out and then watching this transpire yesterday, and then you can come in and buy the stock. And that there is a similar action in a number of other names. I also picked up some Twitter off the lows yesterday. Oops, let's see. Got to go back to... and you can see here again that this is undercutting lows here early in the morning. So I just picked it up. I actually think I was buying it in the pre-open along with Snap, and I got decent upside move. That's not a bad percentage move. It's 5-6%, I think. And then you can sell into it or lay back, set a trailing stop. Usually if I do, so for example, let me show you something here. So let's look at Twitter or even Snap yesterday. This is yesterday. Okay, so early in the morning, right at the opening, here's the opening. Right here. Okay, and you can see right at the opening it shook out and then tossed higher, and then it never really looked back. So once I get in and I'm up, I'll use like the 20 period line as a trailing stop or my entry point. So I ensure that I'm not going to lose money. But in this case, I could exit here. And then later in the day, as it turns, I can come back in here as it gets back above the 20 period line, using the 20 period line, that's the blue one, as a stop. And so you can work and you're able to kind of wring some profits out of it. But it's mostly, you know, swing trading type stuff. And but you can catch a lot of this movement off the lows, because I've noticed when you get this sort of oversold rally and a reflex move, you can actually do pretty well. Even just on an intraday basis, you can make a fair amount of money pretty quickly. So, you know, it's a swing trading technique. You got to be very nimble, you got to be very shrewd, and you basically have to be in a position where you're not feeling any emotion and you're not feeling any particular bias about the market one way or the other. And the one thing I know about this market, at least now, is that the last thing it does is follow through on action one way or the other. So when it looks like you have evidence of bearishness and some people think that they're sensing selling pressure or whatever, that's usually when the market just turns around and flips on you. And so when that happens, the undercut and rally setup becomes your most potent weapon. And I love to use that on a day like yesterday. And it's why I covered my shorts on Wednesday and just came in with cash on yesterday morning so I could think straight and be ready for anything, because I also felt like, yeah, if they gap it down a little bit, that's probably just going to turn out to be a short-term exhaustion, which is kind of what happened, I think. And you know, if I had a great day the day before where some of these shorts are breaking $4 or $5, do I need to push it? You know, especially in this environment. Now, if this was, you know, 2000 and I was back in the old days, pre-QE, yeah, I might go ahead and try and slam them. But what I've noticed is if something starts working for you really well on the short side, in the old days you would just pile on the thing and keep shorting it, and then it would just blow apart. You make a bunch of money. Now if you do that and your initial position is showing a decent profit, and it starts to break, and you're up $3-4 on the position, 5, 6, 7, 8, 10%, and you start jumping on it and averaging up or increasing the position, they'll just flip it on you. And so I don't do that. My initial positions have to do the work these days, and if you can get a nice break to the downside, it's very helpful. So, but suffice it to say, with all this volatility, for me, this is like a bonanza type of week. But only if you play it correctly. If you don't, you can get caught on the wrong side. Like if you're trying to short stocks yesterday at the opening and you think they're all breaking support and blowing apart, well, they would have turned on you and slammed you. So you could have lost a lot of money. So let's say you got shaken out everything on Wednesday because you were heavy long on full margin, maybe more. Is that possible? Well, just say fully invested or on margin, shall we say. You could have gotten shaken out. Then you think you're going to get short, and then they just slam them in your face. And that's just the way this market works, which tells me, as Dr. K was saying, that there's a lot of manipulation, and it's mostly QE based. I don't see this as steady, say, secular accumulation of stocks, but that doesn't really matter because you get some great trends in stocks one way or the other. And I think that's really what you're playing for. So that said, we can go through, I want to go through the focus list, and I'm not going to use that chart. Let's go through, I actually use a variety of systems these days. I use Telechart 2000, HCS Investor, which is my weapon of choice and my main squeeze, and I also have MarketSmith, mainly for data purposes and just to see what other people are seeing. So, and I have to admit, MarketSmith, they've improved the product a lot, and I think it's actually as good, maybe in some ways, maybe even better than Wanda, which is their institutional product, and they charge $25,000 a year for that, whereas they charge $1,200 for MarketSmith. Meanwhile, HCSI is a $699 a year product, and IntelliChart 2000 I think is a couple $100. So you have a lot of choices, and there's stockcharts.com, which is I think $125 a year. So people always ask me what I recommend. I think whatever you can afford, and then as many of them as you can get your hands on. Someone says MarketSmith not better than HCSI. I think in terms of interpreting technical information, no, it's not even close. So, and some of my best ideas come off of HCSI. I'm noticing BABA is starting to give it up. You know, I'd almost look at this. I did short NVIDIA near the highs, and I scalped that. It got down to 136, and I scalped that. You can see on this the 620 chart what's going on here, and it's basically what you see here, and this is another way where I'll use it. You get a MACD stretch here, and then it crosses. Okay, well, it's NVIDIA, and the market's jamming, so I'm looking for it maybe to retest the high. So it does, and it seems to run into resistance at 138, and the MACD line is still kind of fluttering around. So I just take a position there, use the high of the day as a stop. It's pretty tight. So it breaks down, it gets down into here. You get a MACD stretch down here, so cover the stock, and it's obviously now turning back to the upside and starting to look prettier. So I don't know. This is a monster stock as far as bull situations goes, and so it's not something I can scalp. You know, these kind of moves, but you're not going to make a ton of money doing that. But it does keep your psychology even. And on the pullback and turn yesterday, you could also go long the stock. So, and I'll go in long or short on something, and I'll go in big, and I'm moving quickly. So. And I know it's not for everybody. I sent out a piece yesterday explaining my methods and why they're not really at odds with the idea of riding a longer term trend in a stock, simply because what I'm trying to do is campaign a stock on the upside. And that's kind of what I did in 99 as well. In those last 2-3 months of the year, I was up 1,001%. Okay, that was almost twice as much as anybody else I knew during that year, and I knew a lot of people who put up some big numbers. But the way I was able to do that, because in the O'Neill account I was running, I was only up 518 or something like that. So I did 2x what I did there. But how did I do that? It was by swing trading a lot of the moves. And if you go back and study the weekly charts of stocks in 1999, I was actually looking at those last night. the weekly volatility was pretty big. So, you know, when we talk about this market being volatile, yeah, but there's been other markets that are volatile. But if you're going to wring out and optimize your performance, swing trading, and if you can do it right, will do the trick. You know, I would say in 2014 I was up triple digits, and that was because I was successful that way. So this year I would have to say not as successful, but I think it's a little crazier in terms of just the weird news movements, and you know, something comes out about Trump. Trump says the word Russia, and everyone wants to impeach him, or his brother's sister's uncle's girlfriend's cousin met with somebody from Russia, and that becomes a scandal. So, you know, it's just kind of that sort of situation, and we've seen that with the financials. So you have the XLF, for example. You know, this had a big move after the election on the hopes that you would see Dodd-Frank revoked, but instead what you get is this kind of this head and shoulders-y looking formation like on the XLF, which you can, if you look at this, and I don't know if maybe this has no predictive value. It certainly wouldn't surprise me if that turned out to be the case the way this market is, but you can see that after this big move to the upside, it failed on the breakout here, and now it's just fluttering around below the 50-day line, and so it almost looks like it's a short to me. But what does this imply? If it's in the bag that the Fed is going to raise rates, and you're actually, if you look at the inflation data like in China and elsewhere, it seems like things are more deflationary than inflationary right now. So on that basis, perhaps then maybe there aren't going to be more interest rate increases, and maybe the economy isn't growing as strong as people grow. Now, the one thing I would point out about the jobs numbers, and the Fed is always talking about how that is, you know, we're at full employment, but that's a bunch of crap because they count heads. So if somebody works for 1 hour during the week, they're counted as one job. And in a gig economy, a lot of people are working 1 hour a day or 2 hours a day. And I'm reading a book by David Stockman. I mentioned that last week. And he pointed out if you actually use hours worked and you come up in full employment situations, I think he says like 420 billion hours under full employment. Right now we're about 230 or something like that. So he was saying that really based on actual hours worked, the unemployment rate is like 43% or something like that, maybe more, I forget. But so is that what all of this is telling us? And so I'm watching this, you know, you watch like a JPM, this is the biggest of the big stock financials, one of them, and it undercut the lows yesterday, see that, and it rallied, so you get an undercut and rally move here. So obviously you're not trying to short it on this breach, but it would have been nicely shortable up here. Citigroup is a little bit better. Notice this. You had some pocket pivots in here, believe it or not, and I'm not sure what's driving the Citigroup, but I think you have 1, 2 here, right at the 10-day line, right there and right there. And of course, it breaks out, it looks really strong, and then slam, and then it looks really ugly, and then boom, it goes back the other way. So these are the algos running wild like a herd of horses out in Wyoming. Anybody care and live out in Wyoming? Beautiful place. Montana also. If you think it's so damn cold during the winter, I'd think about moving there. But do they have state taxes? Anybody out there? Somebody here in Jackson. Yeah. Jackson Hole or Jackson? No taxes. Yeah, and it's absolutely beautiful there. I mean, one of the most beautiful places, Montana. I remember camping out in Montana, in Deer Lodge, Montana, and going to Bozeman and Butte, which is a beautiful little town, and it's actually on a butte, which is interesting. But anyways, truth in advertising there. Jackson Hole is a region. Okay, thanks for that. Now I know. I mean, I don't claim to be an expert on Wyoming. Anyways, beautiful area. You can go see where General Custer got wasted by a bunch of shrewd Native Americans. And I should point out, my mother just had her DNA done by, what's that, 23andMe or whatever. Turns out she's 40% Native American. So if you see me wearing a headdress, I'll just know that I'm celebrating my cultural heritage. Anyways, come visit next ski season. I don't ski anymore because of my bum knee, but anyways, where were we? Let's get talking about stocks. So let's look at, say, a Netflix. Okay, this is breaking down hard, but rallying into the 10-day moving average. What's our volume rate on this right now, Dr. K?
Netflix is at
Netflix minus 19.
23.
What do you got?
Minus 23.
Yeah, and I've got minus 19. So that's telling you it's running out of gas. So this could be shortable here, you know, and I'm not saying that this is going to blow apart, but if you look at this, it tends to run up and maybe it bases and the market corrects and it hits a 50-day. So you could get a scalp from here to here, and I would play that. Okay, I have no problem with that. There's nothing better in my view than being short something you were long and then being able to cover your short and go long it again at a lower price. Let's look at now. This is another one that's on our list. And it's clearing the 100 level. So that's the century mark, and it's not really doing it with any vigor, but right now I'm showing plus 28% on the volume, so it's trying to get through on higher volume, so that actually looks okay. Market's up, Dow's at 165. See, what happens is they take the dial, the buy dial on the algo machine, and they just keep turning it up a little bit all day long, so the move is getting pretty hectic at this point. But a lot of stocks are starting to flip out, so or they're stalling out. So I think it's still a matter of which stocks you bought. I also think that the best entries were yesterday using the undercut and rally setups and whatnot. So anyways, NVIDIA we looked at, that's just up there, it's extended. I'd kind of watch this, maybe it comes into the 10-day and sets up. You know, a really nice correction would be really good just to clear the decks here. Maybe get everybody bearish, and then something happens like Trump's able to pass his tax reform proposals, and then that would spark a breakout. So it also gives you a shot or an opportunity to see which of your stocks are the strongest among the things you've been playing. So a lot of the stocks, you know, like BABA, you know, is strong. You know that's been on our focus list for a long time. We haven't taken any of these out, and as we noted Wednesday morning in our focus list notes in the pre-market pulse piece, that a lot of stocks acted pretty well and none of them had really busted or violated their 10-day or 20-day moving averages. There are a couple, but really, you know, if it's Facebook or Netflix, this sort of action probably, you know, this had busted the 20-day, but not really, never violated it, and it didn't get down as far as the 50-day, whereas Facebook bounced off the 50-day, and that presented a near-term trading opportunity in my view. So somebody says, if you want to save on state taxes, drop your portfolio into a Wyoming trust or the Wyoming private trust company. You can then avoid those California taxes aren't. Yeah, it gets kind of sick, actually, because I notice at the top end I'm getting hit with about 63% on the top end as your income increases. And when you total in a 49% Fed, I think, and I don't know what the highest rate is, but it's like they just hit you with all kinds of taxes. So after a while, it's like, why trade? You know, if you make more money, you're just paying 60-something cents on the dollar, and you're just getting hosed. What's the incentive? Anyways, just real quick, I'm short CRM. That the Salesforce, that one had a nice flip out this morning. It was pretty quick. Where did that chart go? eSignal doesn't allow you to toggle between charts, but let's see, maybe it's down here. Yeah, here's CRM. It just got a big MACD stretching across right at the opening, so I'll just hit it there, and then down here now it's just fluttering. It looks like it's triangulating here, forming a little bearish triangle, probably going to break to the downside. We'll see. I mean, if the market reverses, it probably goes down harder. But, you know, I'm not averse to playing something like that if I see it. Meanwhile, you don't want to be shorting now, but that I think is one of the better names, frankly, and it's been acting much better. It broke out after earnings on a gap up and has held, and it's continuing higher. So that's actually done pretty reasonably well there. I'm curious, is anybody making any big money this week? Are you guys, how would you say on balance, are you having a good week, or is it screwing you up? Are you getting shaken out? What is the experience of people? I'm actually having a really good week, so, and I find that surprising, and I'll take it. You know, a lot of times I feel like I'm more lucky than smart at times, and that's just the way this market is. Lumentum, I actually bought this one yesterday. It's right up the 20-day line, and now we're triggering higher, but it's probably going to have to bounce and come back in. But I think this is a great name. We like the story on this. So if you figure this is a breakout point here, and you only, I don't know, you use a trend line breakout here, but it's coming in to test these moving averages, so now it probably needs to tighten up, although this stock doesn't really have a history of tightening up before it moves, but just watch for some sort of a pullback into the 20-day line. That would be your most optimal entry point, I think, on a pullback, and that's what you'd be waiting for if you're not already long the thing. So let's see. Applied Opto, I mean, this was another one, came right to the top of the base yesterday and then posted a pocket pivot off the 10-day line. And it's now back at the high, so I think this probably just kind of yanks around in here. I noticed just watching CRM, it's been coming down steadily all day, but recently, every time the market goes up, it tries to rally with the market, but then it just kind of futzes back to the downside. So it's kind of weak. That might turn out to be a good short no matter what the market does, and that happens on occasion if anybody's been working, say, oil stock short. We looked at Amazon. Dr. Perry already mentioned that. But again, that one got tagged on heavy volume, and now you're rallying back up on volume that's 30% above average. So it comes right back. So there, you know, if you're long these things and you're playing them for the longer trend, there's no reason to sell them, okay? Because number one, you never violated the 10-day line. Number two, you never violated the 20-day line. And I think at this point, if you own this stock, you probably can use the 7-week rule and just go with the 50-day moving average as your maximum selling guide. Now, obviously, this is not how I would handle it. I would be trading it in between all this. But the other thing is Amazon, you can get excited about Amazon, but a 10% move is 96 points. So, you know, if you see it move 96 points, you can bet all the pundits on CNBC and Fox Business News are going to be spewing all over themselves in giddiness. But the reality is you get a better move off of something like Applied Opto in just a few days. You know, this was like from here when we put out the pocket pivot report, I guess you got, you know, you get another 10% or 20% or more. So that would be 180 Amazon points. And that's just in a few days. And you can get big in this stock because it trades 2.9 million shares a day. It's fairly liquid. And so, you know, you get better juice out of this than you do out of an Amazon. So, so in terms of time value, that has a lot better time value. Same thing with light. You know, if you bought it when we put it on, and we were talking about it here in the webinar at the time, right down here around the, say, 49, 50 level, and you get 10% in just a few days. Well, Amazon's got to go 96 points to do that, and it hasn't even done that since, say, late March. So, you know, it's gone from 900 to 967. So it's probably done it. Yeah, it's been done about 107 points since late March. So if that gets you excited and you like slow things, then go for it. But you know, different strokes for different folks. Somebody says we were up 8% month to date through Tuesday after Wednesday. We were up only 2.7% month to date after Wednesday. Wow, that's a pretty. So that's you're basically, Paul. I'm assuming that you're running a portfolio there. That's a little slower, but that just gives you an idea how much things were hammered. So I guess you're not getting much recovery then on this bounce. And the reality is, if you look at it on the index, it's okay, that's a nice break, and now you're rallying up to the 10-day. There are some stocks that have gone up back to their highs or to new highs like Bob or Amazon, but a lot of them look like this, and I think it's still, you're still not out of the woods yet. Okay, so I think, and you look at the S&P, yeah, it's back above the 50-day. So I would say that at least what you can do here, if you think this rally may have legs, and let's say you were smart and you bought some things yesterday using the undercut and rally setup, which I don't know how many times I've said that when the market gets in an oversold condition and bounces and has a reflex rally, that becomes your most potent weapon as an entry signal. And it's easily handled, as I already pointed out with the BABA example. So if you did and you're up, and you know, there's a number of these you would be up on, anything from Twitter to BABA and a few others. Light was another one. AAOI was another one I picked up off of the 20-day. Then you can hang, and if this breaks the 50-day moving average, then you know you've got some issues. So now let's look at the NYA. That's doing the same thing. Let's look at the Russell. The volume's not going to be right here, but that's below its 50-day, so it's much weaker. All right, let's continue. Baozun, oh boy, this is a fun one. But this is a trader, you know, and this thing has, we liked it down in here, and once it got going, it ran up after earnings, and it's hanging in there. So it's trying to settle in. But it's probably going to need some time to settle down, and I just watch how it acts along the 10-day and the 20-day. If you're long it, then and you bought it down here, then you've got plenty of cushion. And unless you're me trying to trade this thing, you could use a 20-day exponential moving average right now at 1882 as a maximum selling guide, because you certainly don't want it to go all the way back to the 50-day line. So I think that makes total sense in terms of how you would handle this, even though it's pretty nutty and it's moving around in a 20% range, as we pointed out this morning. Chem hours, this one's acting fine. See, this is another one that did not break its 10-day moving average. So Coherent, same thing. It's just hanging up there. It looks okay. I don't see any problems. But if it started to blow through the 240, well, actually, what is this Bible gap up low here? 240. If it started to bust that and volume picked up, then maybe you got a problem. But if you're long this thing, you could use that as your trailing stop, okay? Or you could use a 20-day exponential at 233 as your trailing stop, depending on how you want to handle it. If you're long it down here, when we first put it on as a pocket pivot down in here, around 190, maybe a little lower. Any questions? I'm not seeing much. Frac, fake book. We looked at that. JD got volume support at the 10-day line, so that looks okay. But you know, this is kind of straight down, straight up. I almost think it could be shortable here. I don't know. Maybe I'm on drugs, but hey, I shorted CRM today, and I'm getting away with that right now. I think it's making lower lows. Is it? Is it? Close. The low for the day is 88.08. We're at 88.30. Okay, a few more cents. We talked about Lumentum, Momo. This is the Momo stock. Earnings come out next week, so you don't need to be playing with this and holding into earnings. I don't think I would. I would just, you got a nice trade off the 20-day exponential moving average. We talked about that last week in our notes, focus list notes in the morning. So you could have bought it there. You'd be up a nice, about 10% there in a couple, 3 days. So again, there's time value for you. 10% move in 3 days versus Amazon's 10% move in March, let's see, April, May, in a couple of months, a month and a half. So, you know, that kind of stuff for me works very well. Okay, where are we? Netflix, we talked about. ServiceNow, we talked about NVIDIA. Snap. Snap kind of sucks, actually. That was one I bought yesterday, and off the lows underneath 20, and it rallied nicely, and now it's just kind of bopping around. It's not really, I mean, it's not coming apart. The volume is very light. What's our volume rate on this one right now?
Snap's got minus 31.
Okay, and I'm showing minus 29, and that's about 10, 15 minutes delayed. So that means that the selling, the volume is drying up. But see how it's holding in a nice tight little flag? So this would be considered a Wyckoffean retest, because basically what you have is a low here. So you had the undercut and rally down here last week, and you bought it there, and now you're up on the stock. So if you still own it, I traded it. I basically bailed out up here. And I think there was one morning it was up above 21 in pre-open, and that was a good spot to trade it. One of the things about Snap is if they open it up in the morning, it's usually going to come in first. And if they open it down in the morning, then it's probably going to come in and then push higher. So it just seems to be like that. Like if you just look at this, you can see, I don't know if you can see this, but you can see here they open it up here. So it opens down slightly from the prior day, and so it moves up. The next day it opens slightly up here, you know, or flat, and it goes down. And then yesterday it opens down and it goes up. And then today it opens slightly up and it goes down. And it seems to have that pattern. I don't know, it's kind of weird that way. But, you know, that's kind of the daily noise. But I watch that sort of stuff, especially if I'm swing trading something. So, but now you have this low, which is 1973. And so that can be your support level if you're using that. You can use that as a trailing stop if you came in here on the undercut and rally down here, okay? But what you notice is the volume is declining, and it's sort of drifting in slightly. But it's really just holding in a tight little flag here. There's your little flag. And it's not really breaking down. So that, to me, that's retesting as it pulls in. It's retesting this low, but it's not coming anywhere near it. So that is a Wyckoffean retest that occurs on light volume. And that's constructive, you know. But what does that mean here? Do you enter the stock here? I think it's going to depend on what the general market does. If the market starts to come off again, then it probably will come down and get closer to retesting it. But I would just use, if you're trying to sit with this and you bought it lower, okay, you had a good entry, and you're trying to sit with it, then I think the 1973 low here in the middle is your first stop, or you can just use your entry point. You know, it's like, okay, either the trade works big for me or it doesn't work at all. And if it comes back to the flat line for me, I'm just going to bail. And I'll do that a lot, actually. So, anyways. Goose. Somebody's talking about, oh, you got to love the symbol, though. But this is a stock that you can get goosed on if you're not careful. But I thought this looked kind of interesting in here, and it's pulling back. But now it's pulling back to the 10-day, so maybe that puts it into a viable position using the low of the day or the 10-day line as your stop. So, frack. You put that in twice, Scotty. What are you drinking too much coffee this morning? Well, that's a nice roundabout move. Are you bragging again? Did you buy this one yesterday? Like also Etsy? Was I talking about Etsy last week, you guys? Did I not talk about Etsy last week? I said you could take 10,000 shares and just hang with it and see what happens as long as it doesn't blow through the 20-day. And what do you get? You get a nice big gap up on Monday, which is about 25%. Bada bing, bada boom, just like that. So, you know, don't underestimate the power of the ugly duckling. And I would say frack may be similar. What is frack anyways? Does it have something to do with fracking? Yes, you're long it. So you're bragging, aren't you? All right. By the way, I meant to tell you, Scotty, that I've got some Monopolova Polish vodka, potato vodka, $12.99 for a bottle. And in blind taste tests, it's the first one to take down Five Wives. And before that, Five Wives was beating Chopin, Glacier, Blue Ice, Tito's, trying to remember all the ones we tasted them against. And Monopolova won. So, but it's only $12.99 a bottle. So I think that's the one I like. So I threw away all my other vodkas. All I have now is Monopolova and the Five Wives. There goes CRM now, 18.18 on the bid. Thank you. I know you're shocked. I was shocked too, because I thought, okay, Five Wives have been beating all these other vodkas. Monopolova is kind of this cheesy Polish brand, but it's got like the generic label on it. Remember the old generic stuff, like up the airplanes? They used to say airplane on them. I don't know. Food on the cans, stuff like that. Anyways, sorry about that. Sorry to get distracted by vodka, but I mean, this market's kind of like that. So, all right. What else is there? Snap, we went off on. Okay. Square is, now Square's another one. It blew below its 10-day line, but again, there's nothing abnormal here in terms of, yeah, okay, you tried to break out here, but you're stalling. You can see that. So I'm not going to buy that, obviously, but you had a viable gap up here, and you're basically hanging out within the range. So if you're long this thing, and I'm assuming if you're long it, you're probably long it from when we started talking about it down here, because we've had this on our focus list for a long time. Then I think the 20-day line becomes your maximum downside selling guide. And that would probably be a very happy place to be if you have to sell it and the market just blows apart. But I think if a lot of these things are going to break down further, and you're going to see some of these names that have been holding above their 10-day and 20-day lines, then I think the market's going to have to get into a lot more trouble. And I thoroughly think that's a possibility. I'm not going to discount that. And I think what will happen is it'll be like Wednesday, where they're going to pull the rug out on you and everything's going to be down big right at the outset. So you're going to be sitting there twiddling your thumbs wondering what to do, and they just keep hammering you, then you finally get shaken out, and then they turn the market higher. Yeah, generic beer cans, I remember that. It's like stuff, it'd be like a white package with just like block, Helvetica, big block Helvetica letters that say beer. Or I remember my mom got something called, that had butter on it. They were sticks of butter. Anyways, all right, let's keep going. Tesla I thought was a short on Tuesday. I shorted, then I covered it on Wednesday into the close, and so it broke down hard, and you turn and rallied here. I don't know, I just felt I'd want to short on a rally up into the 10-day line, and so now it's back up, volume is light. Now, I think if you look at this on a weekly chart, okay, you know, I know people who get bullish on Tesla want to think it's going to the moon, and people who get bearish on it think it's going to zero. I don't really care. I just want to play the movement in it, and the movement's from late December, which I pegged, and you can go back to the webinars at the time. I was showing everybody the bottom fishing pocket pivots, and we picked up another pocket pivot down here at about 255, I think it was 260, and it's gone higher since then. It's been on the focus list, and now it's kind of way up here. And the thing to keep in mind here, let's see if I can get this all in. I doubt if I can. And you broke out of this big range. So does this mean it's going to 400? I don't know, maybe. But you get this sort of big churning week in here on heavy volume. So the one thing I also noticed the other day, last couple of days, is that as you're getting up in here, you get this V-shaped move. Okay, so I figured we need a pullback to correct this wedging action because the volume looks like that and it's wedging back to the highs. So you get that. But you notice here you're stalling and running out of gas and it's still wedging. Okay, then you come down on heavy volume. So that's not a constructive correction of the wedge. Okay, it should be occurring on light volume. The next day you try to rally up to 320. This is where I put the short out, and I just noticed the volume is weak and the stock didn't have a lot of juice on the upside there. So what did I do? I shorted it and it broke. And yeah, I got, 13, 14, 15 points, something like that, from top to bottom, but that's not really the point here. I cover, and I think if it breaks, then you could short here using the 10-day line as a stop. Now that said, if we have the stock on as a buy down here, for those who want to give this more room, you can use either a clean violation of the 20-day exponential as your stop, or the 50-day moving average as your maximum selling guide. Uh-oh. Getting an allergy attack here, so that's what I get for having the window open. Yeah, First Solar is another one. And you know what? I looked at that yesterday. That was one stock I looked at because it's a classic ugly duckling sort of thing. But, there was, this is one I've been trying to play long from here, and then you got this break. So it gets extended, volume's drying up, so if you're playing it from here, you're selling. Now you get the break hard. Yesterday it was trading down about $1.40, and I'm watching it. It's coming down to the 20-day exponential, and I was thinking about taking some shares, because at first I thought if it broke the 200-day line, this could turn into a short. But of course, given the fact that the market was already down on the opening, then the potential for a sort of a mini exhaustion gap, which it looks like we had on yesterday morning, and then a turn back to the upside, comes into play. So I was actually watching this as a long, and I missed it. And there's a couple of little things going on here. You have this low, it undercut, and it also punched through the 20-day and then spun back through it, up through it. So you could have gone long. And I was looking at it, and I was ready to take shares, and I don't know what happened. I got distracted by some stupid thing. And I look at it a little while later, and it's up back, above the 200-day and moving. So you basically got a supporting type of pocket pivot maneuver off of the 20-day moving average here. So here's your pocket pivot volume signature. But it was down on the day, but just barely. But I think the supporting action, because it's definitely way above average volume, is pretty constructive. So that looks, pretty decent. And along with Sedge, Solar Edge, Scotty, I'm sure, and these are stocks I know you've had. I mean, this thing got through the 200-day. It took a while to get going again. After earnings, it popped, and now it's hanging along the 10-day. I wouldn't be surprised if it goes higher if the general market continues going higher, which so far that's what it's doing today. But other than that, I don't know. These are stocks losing money. I know Solar Edge is, but the whole world's short the thing. So, and First Solar is supposedly going to get their act together, and so far it's hanging in there. But yeah, that was a good one. What do you think about ESNT? Essent Group? Well, I think it looks kind of poopy. So it's breaking the 50-day line today. I guess you'd call that a violation. But that if you're going to get short this, I think you probably did it yesterday or today along the 50-day line. So it looks like a shortable type of situation. It's had a big move, and I don't know, is it pop? No, it just had a big move. It's way up to new high, so it could be failing. But you know, objectively, what I think doesn't really matter. It's the price volume action that matters. And in this case, what do you have? You have a failure at the 20-day and the 50-day after a kind of a wedging rally. You can see the wedging rally here because the volume's declining and it's going up. And then finally it runs out of gas at the peak, which is the lightest volume, and it stalls and then rolls back. Now we're through the 50-day line, so that's at 36, what, 50 or something like that, 36.58. So, you know, maybe from there it's going to break lower and test this low. I don't know. So, you know, all I know is if you short it near the 50-day line, it's working, so you have to decide where your trailing stop is. Any other questions? Let's look at, I still like Quantenna, and I like this action here. It's hanging on. It got some support along the, this was in the Voodoo report the other day. I put this out. You got this supporting action off of the, because it's above average volume and it closes in the upper half and off of the 50-day and the 20-day. So that's good. You got volume today is drying up, I believe. Here comes a UVXY. I'm actually long the UVXY. If anybody follows me on Twitter, I said you have a buy signal on the UVXY at 12.55 using a 12.11 stop. And it's mostly like a hedge if you're long stuff. But now it's starting to turn here. So, and I'm long it. I trade the UVXY based on what I'm seeing in my stocks and also on the basis of the 620 chart. And I'll use a MACD stretch has been the best way to enter it. So, and so I'm long. Now we're pushing up 1308. And I was long it. I went long the thing on Tuesday and got the 35% move on Wednesday and then sold it. And then, of course, it comes in from there. It's really random. I mean, even during the day, I watch this thing trade, and it's just like zip, 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 just back and forth. And it's just crazy. I mean, when volatility has volatility, I guess we're really living in a QE market. But anyways, what other ones look interesting? Weibo. Now, Weibo is very interesting. You have a big Bible gap up. Okay. And my take on this is I'm certainly not going to buy it up here. If you bought it at the beginning of the day near the lows, then you're in the pink right away. Okay. But yesterday, it breaks down, and then yesterday it gaps down. Well, it gaps here, basically flat, and then moves lower. But it comes into this low, which is about, let's check this here. So we hit a low of 71.02. Your low here is 69.54. So as it's coming in, I'm watching for two things here. Number one, a turn, because I'm close to the intraday low of the Bible gap up day, which was Tuesday. But also, if it were to fail through that, it could turn into a short. So I'm not looking at it as like I'm bullish on the stock or I'm bearish. I'm just watching what it's doing. And as that occurs, what I'm really trying to do, the ideal I'm grasping for, or groping for, and maybe sometimes that's all I'm doing, is I'm just trying to keep my head in a completely empty space. In other words, there is no emotion, there is no bias, there is nothing other than I'm just watching the thing play out. And when I see something that looks actionable, I act on it, and I know where my out point is. If it doesn't work, I'm gone. And it's not like I have to stake my reputation on, you know, what the trade. If it doesn't work, it doesn't work. But as a trader now for almost, well, 26 years, time flies when you're having fun, I guess. That's really where I'm at in terms of becoming a better trader. I've been up 4 years in a row, averaging 41% a year. I'm not going to jinx myself by saying I'm going to be up another one, but that's what I'm shooting for. And if I'm up, I'll be happy because that means 5 years in a row that I've been up. And previously, I'd never been up more than 2 years in a row. But what you're doing, and this is something I saw with Bill O'Neill, is that he just became totally in the here and now. And as a trader, just to completely forget about everything else. Don't bullshit yourself. Just and pay attention to what the market's doing, and don't try to impose your view on the market. And that's a very hard thing to do. And I think that's probably the hardest aspect of trading. And that's just what I try to do now. And it's not perfect, but that's what I'm striving for. So for those of you, you know, a lot of you probably just trying to get the basic mechanics down of trading and investing. But after you start doing it for a long time, it's just you against the market. And I think that it's really, ultimately, the final hurdle is the psychological one. Blah, blah, blah. Let's see. What do you think about WHR Whirlpool? Well, it's a gap down and it's pushing up, so I'm not really going to short it here. And has it been a big leader? It's not really a big leader either, so there's not really anything to think. They make nice dishwashers, though, if you're asking what I think. Oh, as a short, but yeah, I mean, you had the shortable gap down, so the high of that would be your stop, so you're stopped out. But I would look for it to fill the gap. That would probably be the best place to go. In this market, you're better off trying to trade the counter trends, or try to go counter to the trend when you do at resistance on the short side and at support or on another kind of rally on the long side. So, I mean, there's a lot of counter trend stuff that you want to try and play against rather than trying to push with something in a momentum type of move. So, oh, I knew this was coming. Somebody says, Gil, thank you for your comments on UVXY. Does Dr. K have any comments? I see we are sitting in cash on his model. Dr. K, you have anything you want to say?
Right now, there's not a favorable entry, because keep in mind it's not a day trading model. So there's different ways to skin UVXY, and obviously many people do trade it because it's one of the most traded vehicles out there, as well as XIV. But right now, there's not a favorable entry, so it's going to stay in cash until it senses that, and that's going to come fairly quickly because of that change, that critical change I made in starting with the April 3rd sell signal. Yes, I'm very well aware. I've had some comments that the model was up over 50%, and that I had started testing it prior to making it live on VoSI in September of last year, and the results speak for themselves. My results, I mean, obviously this is not shared with VoSI members, so it's not real to them, but nevertheless, it was doing very well, and someone has, they said, why haven't you had enough evidence that change you made on April 3rd is not working? And I totally understand that point. The trading has been it's having one of its worst drawdowns since that change was made. I am very cognizant of that. The issue is that, and I've said I will revert back to the old, I will reverse this change that I made on April 3rd, because if I hadn't put the change in, the model would still be up appreciably this year. And I will reverse it out naturally, because I'm obviously, I have my own money invested in this thing, and obviously the objective is to help myself and to help the members make money. But there's a very good reason why I'm still not switching it out, why I'm not reversing it, and I've explained that. And obviously, if it doesn't work, I will reverse it out, but it needs a little bit more time, because I think it will prove out. I could be wrong. I've been wrong before many times, so I'm just tracking the performance of the before and after critical change that I made in early April.
Yeah, and I'm having, we're having our webmaster put up a table that shows the actual results based on the actual email signals that were sent out. So I think it's useful to see what the model has actually done in the present, in the here and now of the actual signals. And then if you choose to use it, this is what, okay, first of all, my own opinion of models is that they're pointless. They don't do anything. And I don't see how they enhance my take on the market or produce great profits any more than I can do with stocks. That's my view. Now, other people are free to have their own opinion. But the objective evidence for the VIX is the VIX model is basically that it's been losing money. But I think the VIX is just too crazy of a vehicle to try and model it. It seems, at times, it almost seems to be random. Like the other day when they had the French election. Now, I mean, I think you could have guessed, and the market probably could have expected that the guy, Macron, was going to win, and the other one, the radical one that's going to take them out of the EU, was going to lose. But yet the VIX went, I mean, I saw the thing drop 4 points. And that seemed like a really bizarre kind of move for it. But I think it's a dangerous thing. So my advice is that people using this VVM model should, A, not be using it if they don't have money to burn, because it's highly risky. So it's not for people who are throwing in all their life savings, think that they're going to make some sort of fortune that's then going to allow them to buy a small island. I think you need to understand the risks of it. But speaking for myself, I've never used models. And I don't really care to use them, and I probably never will, unless you eventually something, you show me something that really works in real time with real signals and real money, then I guess I could be persuaded. But I mean, that's just my view. So I just want to give you guys a balanced view of things.
I think that's a valid view, but keep in mind, just to be strictly accurate, I hate the word model because model confers or implies a black box static strategy that's just a bunch of switches that go on and off based on what it sees, and the market obviously is fluid and doesn't work that way. That's why I don't like that word. I prefer the word strategy because it's not just systematic; it's discretionary as well. And what you'll see with this table we're putting up from an actual member that traded the model since December, what you'll see is December of 2015. What you'll see is that, as you know, the model went through a series of adjustments up until it went. I think it was November of last year. All the adjustments were in place, and what you'll see is that member. That was the low, by the way, for that member, and then it went up 54.3% from that time, from that date of November last year. So that proved out exactly what we were getting in real time on the website, because actually it was 54. Well, you could see it for yourself. I think it was 54.3%. Oddly, it would be that exact. I was kind of surprised because obviously not all the numbers match. Some are greater, some are less, but nevertheless, it was over 50% in both cases. Then, as you'll see, 54.3%, that was right before the April 3rd sell signal. And since then, virtually every signal has been a loss, and that 54% has been reversed to the downside. So again, I understand the person's point. Why are you keeping this change that you made? Hasn't it shown that it's not working? And my answer again is I'm going to give it a little more time, because I do believe that it's a very valuable adjustment. But if I'm wrong, then obviously I will reverse it out, because yes, it's painful to see what I believe to be a significant adjustment completely lose money, for myself and for members. But nevertheless, and I've explained this on the website, the adjustment reduces the number of losses and allows the bigger gains to become even larger. So the profit trajectory increases. The downside, though, is that there is a little bit more risk on the table, and that the drawdowns are a bit larger. I should say a fair bit larger. So maybe what I'll do is I'll have the two running side by side. I don't know. I have to think about this, because then people can be free to choose. Do they want to stay with the old version or the post April 3rd version? So it's going to be something I'm going to think about.
I'm curious, is there anybody on this webinar who has used the model themselves? Anybody? Have you made money? Matt? You have? And how do you achieve that? No, just the MDM. Okay, well, I'm talking about the VVM. I think the MDM works okay, and I think it's for people who want to go nice and slow and use ETFs without having to do too much. That can work for them. But then nobody uses the VVM. Okay.
The VVM, as I've illustrated, is more of a rocket ride. These instruments, all these volatility instruments, as we pointed out, in the text, that they swing wildly, and therefore,
like riding those rockets I see take off out of Vandenberg just north, and then they blow up. They go up and then they blow up. But what about? I have a little. Okay. So I'm guessing there's only one person here who uses it. Okay, so nobody. Okay, well, I don't know. That kind of makes me feel better, because at least I know people aren't getting their heads handed to them. So.
What I noticed is earlier in the year, when it was up over 50% in the first 2-3 months, I think that obviously there's some people getting on board, and that's human tendencies. When something does well, you jump on board, and then
right.
You take much time after that for it to peak, because of the April 3rd. That was the top of the April 3rd. So then they're losing money, and right now with the model where it's at, no one wants to get in, and that's the human tendency too. And that's why I'm thinking maybe what I should do is put up the model before the change with all the real-time signals, because that obviously in hindsight I'm thinking, well, gee, if I hadn't made the change, the model would be doing great right now. but that doesn't matter. What matters is what you get in real time. And I have a firm belief about this change I made April 3rd. We'll see if I'm right or wrong. There's not an ego here, in the sense, if I'm wrong, I'm perfectly, it's going to be reversed, because our objective, our sole objective, is how much do we make at the end of the day.
Yeah, and I think with the focus list, you guys should focus on the focus list, because I think that thing's been a charmer. I mean, I've been blown away by how well some of those names have done, and frankly, I wish I had just gone 200% long the focus list and sat there all year, because probably be doing a lot better than trying to swing trade. Anyways, I noticed CRM breaking below the lows, 87.90 bid. I think we could come in. This is going to be crazy, you guys. So, just be very cautious. If you enter, yes, take advantage of the oversold conditions to use proper setups where you can control your risk. If you're long stocks and you're sitting with them, which I think is totally fine and understandable if that's how you operate, then watch for breaches of the 10-day, the 20-day, and the 50-day moving averages as your sell signals, and just stick to those. If we get into a bear market, you will be forced out one way or another. But that said, you don't necessarily have to try and get fancy and swing trade it the way I do, or get short into the peak, and because if it keeps going, you could get smacked. But I think for the most part, if you're operating on a longer term basis, the 7-week rule works pretty well. And there are plenty of stocks that continue to act well, and we'll see where this thing goes. It seems to me, though, that we're at a point where the market could run into some turbulence, and that could mean some nasty down days, and then obviously the wild oversold rallies like we got yesterday in stocks, not so much in the indexes. So I think we're in a period where things are going to be a little bit in flux, and so I think that's just how it's going to be. So just stay nimble, know where your out points are. You could always raise cash into extended upside moves. Like I think if I owned WB this morning, it was up like $2. Now it's down. Weibo, you would sell into that, above 80, because it's going back to the highs right away, and that's kind of a volatile move there, and I think it could reverse. It could also be a little bit climactic, because it had a big move from here, and notice how starting from here, you're up 1, 2, 3, 4, 5, 6, 7, 6 out of 7, 7 out of 8, 8 out of 9 days, and this is your biggest point move in the entire run. So that could be a little bit parabolic and climactic here, so that could imply that you're going to need to at least chop around and form a base in here somewhere. So we'll see how that goes. But in the meantime, we're done. That's about all I've got. So some perspective on how I'm trying to handle this market. I think we're still in a little bit of a danger zone. But on the other hand, you have to be nimble also on the short side and take what you get when you get it. And that's pretty much it. So on that note, we'll end this webinar. Thanks for showing up. You guys have a great week, and we'll catch you next week.
So long, everyone.